Hello, this is Shlomo Benartzi from UCLA. We're going to interview today Mark Iwry, Senior Advisor to the Secretary of Treasury. Thank you for being with us, Mark.
Shlomo, it's a pleasure to be with you.
I want to talk about obviously 401k plans today, but I want to start actually before they existed. The world before 401k plans. Some people think about it as that was the perfect, the good old days. And I want your take about whether it was really the good old days where everything was fine.
Shlomo, I agree with your characterization. People often do look at it with a certain mythological slant. The defined benefit pension plan did have a serious erosion and decline, which continues today. And it did have its heyday in the earlier pre-401k era. But the defined benefit pension plan is the way that it reached people, the number of people it reached, and the actual amount of benefits that it delivered is sometimes exaggerated with nostalgia. It was great for a lot of middle-income working families, delivered lifetime income, provided a benefit that the employer made happen so the individual didn't have to take any initiative. But oftentimes these plans did not actually cover many people who were working, and many people who were working and were covered by one of these plans actually didn't get much benefit out of them, either because they left the company that sponsored the plan relatively early, or they weren't there very long. So the number of people who got very substantial benefits from these plans was considerable, but probably less than many people imagine.
So you really, I guess, in a sense, referring to a large degree also to the mobility risk that in 401k
Right.
plans you have investment risk. In the old pension plans, if you change jobs, you might actually not even get to the point where you earned any benefits.
That's correct. You might not have vested, as they say, in the benefits if you change jobs too quickly. And each of the types of plans has its virtues, the defined benefit pension and the 401k, but the best is to have both.
So the good old days might have not been so good,
Right.
just okay.
Right.
So let's fast forward to 1978. The 401k code was added, and what happened in those couple of years, let's say 1978, 79, 1980, did 401k plans, really made a big difference early on?
They didn't take off right away, and this was in part, I think, because the method of contributing to the plans required more initiative on the part of the employee than it does today. If the employee had to actually write a check or take some action in order to contribute to the plan, that would make it likely that fewer people would actually get around to doing it. If the employee, however, could contribute by salary reduction or payroll deduction, the way taxes are withheld from our pay and certain other things are taken out of our pay, that is a kind of automatic method. Once it starts, the individual doesn't have to do anything to keep it going. The money just comes out of your account on a regular basis. And that was introduced in the early 80s and helped 401ks really take off. The other factor were regulations, that once the 401k was put into the tax code, there were still significant questions about how it worked. And it took Treasury and IRS a little time to figure out what the rules ought to be and flesh it out with regulations.
So is the main lesson about 401k plans and the big change that took place in 1981, where people didn't have to write a check? They could literally have the money be taken from their paycheck before they even see it, touch it, spend it. It's automatic.
Right.
Is that really the big difference you think that made 401k plans what we think of them today, just making it easy for employees?
I think that's really it. I think that the convenience of being able to continue saving without having to remember to write a check or take other particular action, without having to make further decisions. Once it gets going, it just operates on automatic pilot.
Got you. So this is really interesting because we're learning more and more in behavioral economics that making things easy for people makes a big difference. I just learned about Abu Dhabi. They have a big problem there with breast cancer because women are both afraid to go and be tested, but it's also not that convenient. And they found out that making it more convenient, like being able to go and be tested late night, makes a huge difference.
Right.
So I think that that's very insightful. And when you think about making things easy, fast forward 25 years later, 401k plans, 2006, and the Pension Protection Act, that made things even easier to some extent. Let's talk a little bit about the Pension Protection Act and making it even easier for employees to save.
Well, Shlomo, what particularly made it easier was the introduction of automatic enrollment, which meant that signing up for the plan would be convenient because it would happen by default. The individual who is hired would not have to actually make a decision affirmatively to join the plan and fill out a form and hand it in, but rather would be enrolled in the plan if the employer wanted to do it this way automatically. And if the individual wanted to opt out, they could opt out, or they could opt for a higher or lower contribution level or a different investment from the one that the employer arranged as the automatic contribution or investment. And that was introduced in 1998. There were rulings that the Treasury Department issued beginning in 98 that said a 401k plan can sign people up this way through automatic enrollment. Just have to give them enough advance notice so that they know that they're going to be signed up and some of their paycheck will be devoted to this 401k account unless the individual chooses otherwise. So it's still a choice on the part of the individual. It's just that if you do nothing as an employee, you'll be saving in the plan rather than the traditional method if you have to sign up for the plan, which is if you do nothing, you don't get around to signing up, you're not saving. And that started in 1998 with a Treasury IRS ruling. And over the period 98 to 2006, this pattern of signing people up automatically spread, particularly in the larger 401ks. And by 2006, the surveys suggested that maybe a third or approaching a third of the larger 401ks were using this easy method, this convenient automatic enrollment. Then Congress wanted to add to this effect, to this movement, if you will, and it enacted legislation that made it still more convenient for plan sponsors and easier for plan sponsors to offer this automatic enrollment.
So let's talk about some results. I hear that in a typical 401k plan where you have automatic enrollment, 90% participate. Let's talk about what this has really done for savings in America.
Right. So before automatic enrollment, or in plans that don't use automatic enrollment and ask an individual to sign up, typically the percentage of people who are eligible to sign up, who actually do sign up, was somewhere in the order of 2/3 or 3/4, 70%, something like that. With automatic enrollment, it has jumped typically to, as you say, 90% or even higher than 90%. Very few people, in other words, will actually opt out of the plan. And it has made a big difference because millions of people are now opted into plans who might otherwise have not been savings. So to get the national participation rate in 401ks moved up from something like 2/3 or 3/4 to something like 90 or 95%, obviously affects millions of working families.
So I hear that a lot of financial institutions and employers are noticing there's dramatic results,
Right.
where you overnight literally can get 90-some% of the employees to save for retirement. And they notice at the same time that the industry roughly spends $500 million to $1 billion a year educating people on 401k plans, and they start asking questions like, if we just make it easy for people to save and they all save, why should we spend money on financial education?
Right. So, Shlomo, the effort to encourage people to actually participate in these plans and to save has had several prongs over time. One has been the matching contribution the employer will offer to match what the employee puts into the plan. For example, the employee puts $1 in, the employer will put 50 cents in to the same account. In addition, the education or jawboning of employees, it's clear that the match has some effect. The literature differs on exactly how much effect it has, but it has some impact on employees' willingness to save. Financial education, less clear. We want to believe that it helps. It's always good to have more education, and the students in your class who are looking at this, I'm sure, would all tend to agree. But your question is bang for the buck. How much are we getting out of the financial education going on in the workplace relating to things like 401ks relative to how much is being spent on it? And so the automatic enrollment has introduced another tool to our saving toolbox, namely just getting people into the plan by default, automatically, giving them a kind of standard package of contribution level and investments that they can go with if they don't want to make their own decisions that are different from that, or if they want to procrastinate their own decisions till they've learned more and gotten more educated. So people are asking the question, if we've got automatic features like this and we've got a matching contribution, is there much additional benefit from the spending on financial education? You can make a case that it's still important to have financial education for people to be financially literate. It's still good for them to make choices that are best for their own circumstances and to have the background to make those choices. But to your question, how much money is it worth investing in that if the employer's objective is particularly to get the participation rate higher? You can get the participation higher by these other means, by automatic enrollment in particular.
So we know how to get a lot of people into the plan, but rumors are that there's still some problems with 401k plans, and rumors are that you have a vision for 401k plans 3.0, how we can actually get them to the next level, maybe get people to save more, have more people have access to a plan. What can we do to move the needle and get those plans to the next level?
Right. You can very much, I think, do more than we're doing now. To have automatic enrollment, as we were discussing in the late 90s, is to have taken the plan to a new level originally. You could call the automatic 401k, the one that uses automatic enrollment, a kind of 401k 2.0 relative to the original model that required more initiative on the part of the individual. What we can do better to step up to a new level is to ramp up these automatic features. For example, by enrolling people at a higher level of automatic contribution. 3% of pay has been typical. Employers have found if they auto-enroll people at 5% of pay or 6%, they don't get a lot more people opting out. People go with the default. Auto-enrolling not just new hires, but people who've been with the company for a while or the other employer who aren't contributing to the plan. You can tell those folks, you haven't been contributing, you don't have to, nobody's forcing you, but we will put you into the plan starting January 1, let's say, at 5% of pay, unless you choose otherwise. If you still don't want to participate, just check the decline box and your choice will be honored. But you could really expand potentially the reach of this automatic enrollment. You have a great idea in your book to tell people who might decline to participate that they have another option, and you can embellish this or correct me if I'm not getting it just right. They can start next year or the year after.
Absolutely.
If you're not ready to start saving right now, you might just decline for now, but commit yourself on the same form, electronic or hard copy, to start saving tomorrow, as you would put it, maybe a year from now, beginning of the next year. And that's the kind of thing that can also ramp up the 401k. Employer matching contributions can be increased. That involves an additional cost to the employer. So there are ways of maybe restructuring the match to induce employees to contribute higher amounts, even if the total matching cost to the employer is held constant. And that's another approach. For example, the employer may be matching the employee 50 cents on the dollar up to the first 6% of pay that the employee contributes. If the employer matched 33 cents on the dollar up to the first 9% of pay, the net aggregate outlay for the employer match might be the same, but you might be encouraging people to set a goal of 9% rather than 6% because they know that if they contribute less than the matched amount, they are, as they say, leaving money on the table. They're turning down a match that they could have gotten from the employer. There are also possibilities such as taking a higher matching rate for lower paid people. You could say that the people with the blue collar jobs or people in certain parts of the company would get more of a match up to some limited amount of contributions than everybody else. And that would generally be okay because you're not discriminating in favor of high paid people. You're in effect favoring lower paid people. That might be a combination that an employer could build into its plan, in addition to stretching out the match for people who have more means to contribute higher amounts. There are a variety of other things too, helping to provide more income options in 401k plans. For example, instead of taking a single cash payment out of the plan, a lump sum as it's often called, the employee could be given the choice or even encouraged to take the money on a periodic basis, a monthly payment for the rest of their life or for a very long period of time. An annuity, for example, if the 401k plan sponsor wants to make that available or connect employees with those kinds of options in the marketplace.
So let's talk about that example. I think you've probably met David Blake from the Pension Institute in London. He thinks of our 401k plans as virtually airplanes without a landing gear, because by the time you get to land, you get to retire and you kind of descending, you're decumulating your assets. He feels we haven't really structured the plans to offer actually a really good lending path. We don't have income solutions inside 401k plans. When you think about a lot of those guaranteed products like annuities, a lot of people are scared that the insurance company will not be there in 30, 40 years. And right now, most of it is actually guaranteed by the states, not by the federal government. Is there anything that the government might be able to do to increase the level of comfort of people, that, you know, the promises will be backed up?
Some employers that sponsor these plans are already comfortable that they can offer employees a choice of purchasing an annuity with a thorough look that the employer has taken, sometimes with the advice of independent consultants, at the provider or providers of the annuity. And the employer may be comfortable that this is a reasonable bet for the long term, and the employee can then make their own decision as well. But yes, many employers are hesitating about that fiduciary decision to select a particular annuity provider. And so there's a lot of attention being given now in the regulatory community to this question. The Department of Labor in particular has the jurisdiction over this fiduciary question, and I know they're looking in a quite active way at whether there's anything they can do to give employers more comfort or to make it easier for employers to provide options that involve annuities in 401ks. In a pension plan, a defined benefit pension plan, an annuity has to be offered. The landing gear is built in, if you will, in a different way. The plan can pay an annuity itself, or it could contract with an insurance carrier to provide an annuity. In the 401k, the plan by its structure cannot promise a lifetime payment, but it can contract with an annuity provider to do that, or it can try to approximate that by making long-term regular payments that are not guaranteed for life.
So this is great for the people that have access to a 401k plan, but I hear that more than half of Americans actually do not even have access to it. Their employer doesn't offer it. What can we do for them?
Shlomo, that's a key concern. Very many Americans still don't have an employer retirement plan, such as a 401k, much less a pension plan. And while the percentage is something that depends on which employees you're taking into account, are you just looking at full-time, full-year people, or part-time, part-year, or seasonal, very young, older, etc., agricultural. The fact is that we've got tens of millions of families who do not have access to an employer plan, and that is important because that access is what makes it easier to save. The ability to have that regular payroll deduction or employer contribution happening for the individual, so the individual does not have to take the initiative, make a lot of decisions and choices, and write a check or get online and actually send money to a saving account. So the issue is often referred to as the coverage issue. We're not covering enough people with this retirement saving opportunity or pension. And there have been a number of efforts to expand the availability of employer plans to make them simpler, more attractive for employers. One of the leading proposals is one that the Obama administration has put forward to extend this power of automatic enrollment that has worked successfully in the 401k world to these folks you're talking about, Shlomo, the people who don't have access to an employer plan, by having their employers automatically enroll the employees into payroll deduction savings, which would then be contributed to not an employer plan, because these are employers that thus far have not been persuaded to adopt an employer plan. So the employer would simply let the employee contribute to an IRA. The IRA is in effect the personal or individual retirement savings plan that we have, and that's portable, doesn't attach just to a particular job. It stays with you for your whole life if you wish, and therefore the automatic enrollment of employees into IRAs in cases where we cannot persuade the employer to adopt a 401k or another kind of retirement plan is a fallback that would potentially cover tens of millions of additional workers whose employers are not yet ready to sponsor a plan. A tax credit can be given to those employers to recognize that they have another task if they're to automatically enroll people, but it shouldn't be very difficult for these firms. They're already withholding from people's paychecks for income tax withholding, for unemployment insurance at the state level, and for other things, including very often a direct deposit of paychecks, where the employee will say, I don't want a paper paycheck. I want my paycheck direct deposited into my financial account at a financial institution. If the employer is already doing that, it should not be much of an additional step for the employee to say, oh, and take 6% of it and put it into this different account at a financial institution, the same one or one chosen by the employer. And that way I'll save. That different account will be an individual retirement account, an IRA.
So we've gone through 35 years of the 401k journey.
Yeah.
And there have been a lot of changes. I think a lot of them been positive. We're
Right.
seeing more people joining the plans. But at the end of the day, do you feel we've had enough innovation over those 35 years, or should we speed it up? And if so, how can we?
I think we should do whatever we can to maximize the innovation. We've not had enough. We've had innovation, but speeding it up would be great. There are proposals for various kinds of innovations. This expansion of coverage, automatic IRA, is one of them. The 401k 3.0, which is something that employers can do on their own, doesn't require legislation, which the automatic IRA would require. Doesn't require changes in regulations, which the encouragement of 401ks to have annuities in them would seem to require. But if we press forward on these various fronts at the same time, I think we'd have more innovation. Now, it is also, I think, very helpful to have people in the academic community and the think tank world continuing to provide creative ideas and to suggest ways to innovate in the system. And to the extent that we can experiment with these things, to the extent we can run pilot projects or experiments that prove the concept, that is, of course, very helpful. The kinds of things that behavioral financial folks such as yourself and others are doing are really a key here in moving the ball forward. And the whole automatic enrollment movement is an illustration of that.
So let me talk about two specific ways of maybe speeding up innovation. We've chatted before about the idea of having more field experiments, having the government and the industry and academics collaborate. What's your take on maybe doing small experiments, but a lot more? So for example, telling a plan sponsor, if you're joining this experiment, you're not going to be legally liable. Because we would like to learn, would like to do, in a sense, evidence-based policy.
Right. I think it's a direction that's well worth exploring. You have to be sure that we have authority to waive various kinds of rules that are often intended to protect employees. And so looking to make sure that the experiments don't in some fashion imperil employees or compromise their rights is always a key constraint. But to the extent we can do creative things by experiments and more experiments, as you suggest, I think that's well worth looking at.
So thinking about innovation, I want to bounce by the idea of 401A for Apple, because I think of them as innovative. And the reason I think about it, I'm thinking about mobile technology. We haven't seen a lot of usage of mobile technology in the 401k space, but in Kenya, for example, Safaricom, the main telecom company, been able to get 1/3 of the adults to have a bank account, and those are people who never ever had a bank account. They now have a virtual bank account through their phone.
Right.
Is there any way to maybe use mobile technology and technology more broadly to maybe get people access to 401k plans? Maybe the iPhone will come with a 401k app, and you just click whether your employer sets a plan or not, and you're part of the federal government automatic IRA.
Right. I think that kind of thinking is great. It's creative, and we ought to explore that and see whether technology can help. Technology has helped a lot already simply by making the whole process of saving less costly and easier. And you're talking about a quantum leap forward in making it easier and more convenient for people. So I think that's an exciting possibility.
Let me wrap with my favorite question, which is challenge us. Challenge behavioral economists like me. What would be the one major behavioral change that you would like to see out there, whether it is employees changing their saving behavior, whether it is employers changing some behavior, something that you would like us to work on and try find solutions?
I think one thing that would be really helpful is if you behavioral finance experts could find ways to encourage employers to sponsor the 401k or similar kind of plan, or even make an automatic IRA available for their employees, automatically enrolling people into IRAs. The employer wouldn't have any fiduciary responsibility to select the investments. We could prescribe a national standard investment. The employer would be not having to contribute anything to the plan. But if we could find behavioral strategies for getting employers that are not willing to sponsor a plan, willing to just do this instead, to make available their payroll system for automatic enrollment in employees' own IRAs. And if you can go further and get the employer to actually sponsor a plan, all the better. But even if the second step isn't feasible, that first step could really make a difference.
Thank you very much, Mark.
Thank you, Shlomo. Always a pleasure.